You know, when you actually step onto the floor of a sprawling modern manufacturing plant, your eyes just naturally go to the massive visible movements.
Oh, yeah. The big stuff.
Right. You see the outsized robotic arms swinging car doors into place. You've got the miles of conveyor belts zipping along with all the raw materials. It's loud, it's chaotic, and it feels like this, this living, breathing, mechanical giant.
Absolutely.
But the reality is you're really only seeing the muscle. You're completely missing the cardiovascular system. I mean, you don't see the perfectly calibrated air pressure that's actually, actuating those robotic arms.
Yeah. And if that pressure drops by even a fraction of a PSI, I mean, a robotic arm misaligns a chassis by maybe 3 millimeters. And suddenly the entire assembly line is just producing scrap metal.
Exactly, just scrap. Yeah. And you don't see the heavy-duty industrial vacuums handling volatile chemicals behind the scenes, keeping sterile environments actually sterile. You just don't see the heartbeat. Because the heartbeat of global manufacturing is, well, it's basically invisible.
It is entirely invisible to the naked eye. And yet the stakes literally could not be higher. If that pneumatic heartbeat stops, or if, say, a liquid dosing valve jams for even a fraction of a second, the entire multi-billion-dollar facility just grinds to a catastrophic halt.
Yeah.
I mean, the downtime costs alone can run into the hundreds of thousands of dollars per hour.
And that invisible heartbeat is exactly the subject of our analysis today. So welcome to this special Talk Tickers edition of our deep dive. For those of you joining us for this specific format, Talk Tickers is where we take the incredibly dense, jargon-heavy world of corporate earnings calls and we break them down into highly actionable insights for you, the retail investor.
Right. Our promise to you is simple. We are data forward. We strip away all that Wall Street speak to explain the actual mechanics of the business. We take an opinionated stance on the results, and most importantly, we leave you with a clear roadmap of what to actually do next.
Yep. And today, our mission is dissecting the Q1 2026 earnings call for Ingersoll Rand. Ticker symbol is IRR.
So if we intend to look under the hood of Ingersoll Rand, we really have to navigate past their standard corporate boilerplate. Because if you read their official filings, they describe themselves as a provider of, quote, mission-critical flow creation.
Which means absolutely nothing to a normal person.
Right. It's a very poetic piece of corporate branding, but functionally. It tells an investor very little. What they actually do is engineer and manufacture the extreme high-precision equipment that makes heavy industry possible.
We're talking capital-intensive stuff here.
Exactly. Industrial air compressors, high-velocity blowers, heavy-duty vacuum systems, and incredibly precise medical pumps. I mean, they provide the air, the fluid, and the clean energy transfer systems that the world's largest factories and hospitals absolutely rely on every single day.
And I really want to set the stage right from the jump here, because the underlying tension in this Q1 2026 earnings call, it's palpable. On one hand, you have a solid top-line revenue beat. I mean, the company is demonstrably making money, right? They're growing their sales footprint.
Yeah, the top line looks great.
But if you scrape just beneath the surface numbers, you start to see these persistent, really frustrating margin pressures in their absolute largest business segment. And then to add just a whole layer of geopolitical complexity to the mix, management reported this highly unusual multi-million-dollar order delay in the Middle East.
Which initially sounds like a terrifying macroeconomic red flag.
Oh, absolutely. But as we comb through the transcript, we find that the delay actually proved to be completely temporary and, well, entirely logistical in nature. It's a textbook case of headline numbers masking a much deeper reality.
And to understand that reality, we need to anchor our discussion in the foundational data.
Right.
The headline numbers have to serve as our compass here.
So let's pull those headline metrics directly from the Q1 2026 transcript. We're looking at an adjusted earnings per share, or EPS, of 77 cents. So that represents a 7% increase year over year. Total revenue grew by 8% year over year, which management explicitly noted fell perfectly in line with their internal modeling.
Right, exactly where they expected to be.
Yeah. And adjusted EBITDA landed at $469 million. That puts their adjusted EBITDA margin at 25.4%. And then we get to the forward-looking demand metrics, right? Overall, orders were up 5% year over year, resulting in a total book-to-bill ratio of 1.07.
Now, that 1.07 ratio is an incredibly important metric. We really need to isolate and examine that. In the heavy manufacturing sector, it is one of the single most reliable leading indicators of a company's future health.
Okay, I want to pause the data dump right here because we promised to translate the jargon for you. So for the beginner or even, intermediate investor listening who hasn't really analyzed capital goods or heavy industrial stocks before, we need to clarify what a book-to-bill of 1.07 functionally means. Like, what is the actual mechanical process happening on the factory floor when we say that?
Sure. So think of it as a measurement of intake versus output. The bill portion refers to the tangible products. So let's say 10 heavy-duty air compressors that Ingersoll Rand physically finished building, loaded onto a flatbed truck, shipped to a customer, and actually issued an invoice for during this quarter.
Okay, so that represents their current recognized revenue.
Exactly. Now, the book portion refers to the brand new purchase orders that customers just signed and submitted for future delivery.
So a book-to-bill ratio is basically just the volume of newly booked orders divided by the volume of completed billed sales.
Yep, that's the math.
So a ratio of exactly 1.0 means the company is booking new business at the exact same velocity that they are shipping finished products out the loading dock. They're basically in a state of perfect equilibrium.
Precisely. Now, if that ratio drops below 1.0, say down to 0.9, that indicates a real structural problem. It means they're burning through their historical backlog faster than their sales team can replenish it. The future pipeline is actively shrinking.
Right.
But Ingersoll Rand reported a book-to-bill of 1.07. Functionally, that means for every $1 of physical product they shipped out the door and collected cash for in Q1, they secured $1.07 in brand new, legally binding orders.
So their backlog isn't just stable, it's actively expanding.
Right. The inbound demand is actually outpacing their current manufacturing delivery capacity.
Okay, so the pipeline is unequivocally full. But a 1.07 ratio really doesn't mean much if they don't have the internal efficiency to actually convert that backlog into cash, right? Especially if supply chains are choked. So looking at these headline numbers overall, the 77 cents EPS, the 8% revenue growth, the expanding backlog, what is the objective verdict on the fundamental health of the enterprise this quarter?
I'd say the objective verdict is that this represents a remarkably sturdy start to 2026. I mean, the executive team, led by CEO Vicente Reynal, really demonstrated the inherent durability of their diverse product portfolio.
Yeah.
They generated $163 million in free cash flow right out of the gate.
And we should underscore that point, right? Because free cash flow is the actual unencumbered cash left over after paying all operating expenses and capital expenditures.
Exactly. It gives them a significant war chest to deploy for things like dividends, stock buybacks, or, future acquisitions. However, and this is the crucial nuance for any investor reading the fine print, that 8% total revenue growth is doing a lot of optical heavy lifting.
So what's it masking?
It is masking a distinct weakness underneath the surface. Specifically, their organic orders, meaning their baseline growth when you completely exclude the impact of recent acquisitions or foreign currency fluctuations, technically dropped by 3% in their core industrial segment.
And there's the core tension of the quarter. Total revenue is climbing at a healthy 8% clip, but organic orders in the primary engine of the company experienced a quantifiable dip. To understand how both of those things can be true at the exact same time, you really have to look past the consolidated corporate earnings statement and examine the two very different operational halves of Ingersoll Rand's business.
Yeah, the divergence in performance between these two segments in Q1 is where the real narrative of this earnings call lives, because they operate under fundamentally different economic realities.
Okay, let's break them down. First, we have the ITS segment, which stands for Industrial Technologies and Services. These are the heavy lifters. This is the classic, gritty, capital-intensive industrial side of the house. We're talking about the massive factory-scale air compressors, the heavy-duty industrial blowers, the large-scale vacuum systems, and the percussional power tools.
Yeah, this is the historical bedrock of the company. It represents the lion's share of their consolidated revenue and employs the vast majority of their manufacturing footprint.
Right. Now, let's look at the financial performance for IDS in Q1. Total revenue for this heavy segment grew by a very respectable 7%.
Hippo.
But as you just noted, organic orders were technically down 3%. And crucially, their adjusted EBITDA margins fell to 26.7%.
Which is a real squeeze.
Yeah. I looked at their fixed costs prior to our discussion, and it just seems like their sprawling factory footprints and unionized labor forces are acting as a heavy anchor right now. I mean, they are generating more total revenue, but they're becoming slightly less profitable in the process. Is that operating leverage just killing their margins?
You hit the nail on the head. Management was actually remarkably transparent about this margin compression, and they pointed to three specific culprits, with operating leverage being the primary driver. You have to remember, in heavy manufacturing, a company carries massive fixed costs.
Right, keeping the lights on.
Exactly. You have to pay the property taxes on a 2 million square foot facility, you have to maintain the heavy machinery, and you have to pay the base salaries of your highly skilled workforce, regardless of whether you produce 100 compressors or 97 compressors.
So when your organic volume drops by even 3%, it disproportionately punishes your bottom line profitability because those massive fixed costs do not shrink alongside the volume decline.
Yes. The revenue drops, but the baseline expenses remain rigid.
So a small dip in organic demand creates a magnified dip in the margin percentage. That makes perfect mathematical sense. Okay, what were the other two factors driving the margin down?
Well, the second factor involves the dilutive impact of global trade policies, specifically the tariffs implemented last year. The costs associated with importing specialized raw materials and components under these new tariff structures are basically acting as a direct tax on their profitability right now.
Makes sense. And the third?
The third culprit, however, is actually a deliberate strategic choice by management. They're making aggressive commercial investments. They're actively choosing to sacrifice short-term margin by pouring capital into expanding their sales teams, funding research and development for new product lines, and, pushing market penetration in historically underrepresented geographic regions.
Okay, I have to push back on that third point. I mean, if you were an executive watching your margins compress due to fixed cost deleverage and international tariffs, why on earth would you actively choose to exacerbate the problem by ramping up R&D and sales expenditures in the exact same quarter? It just seems completely counterintuitive to shareholder value in the short term.
I get that. It is painful in the short term, but it is necessary for long-term market share acquisition. Think about it. If your competitors are pulling back on R&D because of the tough macro environment, and you choose to accelerate your investments, you ensure that when the industrial cycle inevitably turns back upward, your product portfolio is technologically superior.
And your sales force is already entrenched in the new regions.
Exactly. So the margin compression in IS isn't just a story of a struggling market. It's a really complex blend of fixed cost leverage, geopolitical taxation, and deliberate forward-looking capital allocation.
Okay, so heavy industry is feeling the squeeze of rigid fixed costs and tariffs. But when you look at their second business segment, that fixed cost burden completely vanishes. Let's examine PST, or Precision and Science Technologies. Because if ISS is the heavy metal muscle of the company, PST is the microscopic high-tech precision instrument.
Yeah, a completely different beast.
This segment engineers medical dosing valves, automated liquid handling systems for laboratories, highly specialized life sciences equipment.
It is the specialized, higher-margin, IP-heavy sibling to the industrial business. The manufacturing footprint is way smaller, the environments are often sterile clean rooms, and the intellectual property embedded in the products commands a significant premium.
And the financial numbers here are a glaring bright spot. I mean, it is a completely divergent story from the industrial side. Organic orders in PST actually saw a 1% increase. Adjusted EBITDA came in at $122 million, which is up a staggering 15% year over year. But here is the critical metric. Their margins in PST didn't compress at all. They improved by a massive 120 basis points.
And just for clarity, when we say 120 basis points, we are talking about a 1.2% absolute improvement in their profit margin. In the context of a division generating hundreds of millions of dollars in quarterly revenue, a 1.2% expansion in profitability translates to a massive influx of pure bottom-line cash.
Where is that explosive profitability in PST actually originating? Like, what specific products are driving a 15% jump in earnings?
The absolute star player inside this precision segment is their life sciences division. Management explicitly highlighted that life sciences maintained robust, double-digit order growth throughout the entire quarter.
Wow. Double digits.
Yeah. We are talking about the highly engineered fluid pumps and vacuum systems utilized in biopharma manufacturing, complex drug compounding, high-end laboratory research settings. These are environments where precision is non-negotiable. And honestly, customers are highly insensitive to price increases because the equipment is safeguarding millions of dollars worth of pharmaceutical compounds.
So to synthesize the tale of the two segments here, The high-tech precision medical side is basically printing cash and expanding its profit margins rapidly due to pricing power. Meanwhile, the heavy industrial side is growing total revenue through acquisitions, but experiencing a dip in organic demand and shrinking margins due to rigid fixed costs.
That's the summary, yes.
Which leads us to the critical investigation of the episode. Okay, let's unpack this. Why did organic orders drop 3% in the industrial segment? Did the global demand for air compressors suddenly just evaporate, or is there some structural anomaly hidden in the accounting?
This brings us to one of the most revealing disclosures from the entire earnings call. Because it was not a sudden collapse in global industrial demand, it was a highly specific physical logistics breakdown tied directly to global geopolitics.
Yeah, I was reading through the transcript prior to our recording, and the company revealed a $40 million delay in long-cycle orders, specifically tied to the ongoing conflict in the Middle East. Now, my initial reaction as an investor was to assume the worst.
Oh, of course. Demand destruction.
Right. I assumed the macroeconomy in the Middle East was deteriorating rapidly, capital was drying up, and customers were permanently canceling their multi-million-dollar factory build-outs. But according to the CEO's commentary, that is not what transpired at all.
Not even close. When you examine the ground-level reality detailed by Vicente Reynal, it paints a completely different operational picture. He clarified that these delayed orders were massive, quote, long-cycle projects.
Right.
And in heavy industry, a long-cycle project is something like a sprawling petrochemical plant expansion or a new municipal water treatment facility. These projects take years to design and millions of dollars to execute. The core demand for these projects did not vanish. The capital was still allocated.
So what was the issue?
The structural issue was that the physical human beings required to finalize the paperwork literally could not leave their homes due to the acute regional conflict.
That is just a staggering realization. The capital didn't dry up. The physical logistics of executing a massive B2B contract simply froze. The engineers literally couldn't leave their houses to sign the wet ink on the purchase orders?
Precisely. You have to consider the mechanics of closing a $10 million or $20 million industrial contract. It cannot be done via a simple email or a Zoom call. It requires extensive physical site visits, final environmental audits, in-person engineering reviews, highly coordinated logistics.
Right.
Ingersoll Rand confirmed that their regional team members were safe and the customers were safe, but the physical movement required to finalize those massive purchase orders was completely paralyzed by the surrounding conflict. It's just a stark reminder that behind every multi-million-dollar corporate transaction resting on an Excel spreadsheet, there are actual humans who need to safely travel to a job site and sit in the conference room together to execute the agreement.
And the subsequent data proves unequivocally that this was a temporary logistical freeze, not a permanent loss of market share. Because management disclosed that 1/3 of these delayed Middle East orders, which again totaled a very specific $40 million, were already recovered, fully processed, and officially booked in the month of April, mere weeks after the first quarter officially closed.
That is the pivotal data point for any financial analyst modeling the company's future revenue. Because if you mathematically exclude that highly localized, highly specific $40 million transitory delay, Ingersoll Rand's overall organic orders for the ITS segment would not have been down 3%. They would have been exactly flat year over year.
Wait, really? Flat?
Exactly flat. So the entire bearish narrative regarding an organic order dip is essentially an accounting timing anomaly caused by regional conflict temporarily keeping engineers indoors.
Wow. That perfectly contextualizes the delay in the massive multi-year factory installations, which, the industry refers to as long cycle business. It takes quarters, if not years, to, quote, engineer, build, and install. But if the multi-year petrochemical plant is the lagging indicator of economic health, the daily replacement parts are the check engine light of the global economy.
I like that analogy.
Thanks. To really take the real-time temperature of the industrial sector, we have to examine the exact opposite end of the manufacturing spectrum. We have to look at their short-cycle business.
Short-cycle revenue is the immediate heartbeat monitor of real-time industrial activity.
So for you listening, if long-cycle is a massive multi-year infrastructure project, short-cycle is the rapid turnaround inventory. It is the factory floor manager realizing a critical vacuum pump just failed, and ordering an expedited replacement part that ships overnight. It's the daily purchase of core professional power tools. It's the routine aftermarket servicing and maintenance contracts. It basically represents immediate, highly sensitive, daily economic activity.
And historically, the short cycle business acts as the leading indicator for broader industrial recovery. When the global economy begins to rebound from a downturn, factory managers don't immediately approve a billion-dollar new facility.
Right. They don't have the budget yet.
Exactly. First, they start ordering replacement parts to get their idle machines running again. Then they upgrade their hand tools. The short cycle metric moves months before the long cycle metric shows any signs of life.
Well, if the short cycle is the check engine light of the global economy, the dashboard on this earnings call is flashing green.
It is flashing a very strong green. Management shared several highly bullish data points regarding short cycle activity. First, they noted that United States compressor activity has officially stabilized after enduring several previous quarters of intense volatility.
Good to hear.
And second, they pointed out that the U.S. ISM Manufacturing Index has formally moved back above 50 for the past few quarters.
Okay, let's define the ISM index functionally for the audience. The Institute for Supply Management Index is a monthly survey of actual purchasing managers at hundreds of manufacturing companies. They're essentially asked a simple question. Are you buying more materials this month or fewer? A reading below 50 indicates the manufacturing sector is contracting. A reading above 50 means the sector is actively expanding.
Precisely. And the fact that the ISM index is holding steady above 50 proves that the broader U.S. manufacturing sector is transitioning from contraction back into expansion. And you can see that macroeconomic data manifesting directly in Ingersoll Rand's specific product lines. Well, their core power tool business didn't just stabilize. It actively grew organically in the mid-single digits. And in their blower and vacuum business, which is heavily weighted toward short-cycle rapid turnaround orders, they recorded notable year-over-year growth.
So when you synthesize the short-cycle momentum with the fact that their overall backlog is expanding via that 1.07 book-to-bill ratio we talked about, it illustrates a company navigating a complex transition perfectly. The immediate daily orders are accelerating, and the massive delayed infrastructure projects are finally starting to unfreeze and hit the accounting books in Q2.
However, a critical question remains regarding their geographic performance. We know the macroeconomic environment in certain parts of the world, specifically Europe and China, is objectively struggling right now. Yet Ingersoll Rand is somehow finding ways to extract growth in those highly restrictive environments.
Yeah, how is a heavy industrial manufacturer generating global tailwinds when the macroeconomic weather is demonstrably hostile? Let's investigate the European market first. Europe is currently entrenched in a severe, prolonged energy crisis. The cost of industrial power is absolutely exorbitant. Management noted a startling statistic on the call. Currently, in parts of Europe, industrial diesel fuel is actually more expensive than standard petrol.
Which is wild to think about.
It is. The grid dynamics are under immense strain. On paper, sky-high industrial electricity costs sound like a nightmare scenario for a company whose primary product is giant, power-hungry industrial machinery.
It sounds like a catastrophic headwind, but management actually views these elevated energy prices as a significant long-term catalyst for their business model.
It's the classic total cost of ownership pitch. Think about the automotive market. If gasoline is $2 a gallon, you generally don't care that your heavy-duty pickup truck only gets 12 miles to the gallon. The fuel cost is an acceptable operating expense. But if gasoline suddenly spikes to $7 or $8 a gallon, the fundamental math of your daily commute changes overnight. You immediately rush to the dealership to trade that gas guzzler in for a highly efficient hybrid vehicle because the monthly fuel savings will literally pay the financing cost of the new car.
I love that analogy because that exact dynamic is playing out across the European manufacturing landscape right now. Ingersoll Rand doesn't just sell standard air compressors. They engineer extreme energy efficiency. They basically sell the hybrid vehicles of the industrial sector.
Right.
Many legacy compressors in European factories are fixed-speed machines. They simply run at 100% capacity all day, regardless of the actual air demand on the floor, wasting massive amounts of electricity. Ingersoll Rand utilizes advanced variable speed drive technology. So the compressor's motor intelligently speeds up or slows down based on the exact pneumatic demand of the factory floor at any given second.
And the financial impact of that efficiency is staggering. I mean, during the analyst Q&A portion of the call, the CEO cited a specific recent contract win where an Ingersoll Rand technology upgrade saved a European manufacturing customer $15,000 per month on their electricity bill alone.
That is $180,000 a year in pure, unadulterated operational savings dropping straight to the factory's bottom line.
Exactly. When an Ingersoll Rand sales representative can walk into a European factory manager's office, lay out a spreadsheet, and mathematically prove that their premium-priced hardware will literally pay for itself in electricity savings in under 12 months, that is a total cost of ownership, or TCO, sales pitch that is almost impossible for a CFO to reject.
It really is.
The broader European economy could be in a deep recession, but that specific capital expenditure is justified entirely by its own internal ROI.
It effectively decouples their sales growth from the underlying economic malaise of the region. And we're observing a highly analogous yet distinct strategy playing out in China, which represents the other major global macroeconomic headwind right now.
Yeah, the Chinese macroeconomic situation is famously sluggish. Consumer spending is depressed. The real estate sector is highly volatile. Foreign investment has cooled. Historically, Western industrial companies have failed spectacularly in China because they try to import expensive Western manufactured equipment, slap a massive import tariff on it, and sell it to a highly cost-conscious domestic market.
Recipe for disaster.
Yeah. Yet, Ingersoll Rand explicitly pointed out that they are generating positive organic order growth in China. So how are they circumventing the historical pitfalls of Western companies in that region?
They are executing a highly disciplined supply chain strategy they refer to as in China for China. Instead of attempting to manufacture products in the United States or Germany, pay exorbitant shipping costs, navigate complex import duties, and force those inflated costs onto Chinese buyers, they are aggressively localizing their entire value chain.
Oh, I see.
Yeah. They take the premium intellectual property and engineering designs they have developed globally, and they establish local manufacturing facilities within China, sourcing raw materials locally and tailoring the final product specifications specifically for the domestic Chinese market.
And they provided a fascinating case study of this strategy in action. They cited a specific medical device facility operating in China where Ingersoll Rand is drastically outperforming the sluggish underlying industrial market. Because they're highly localized, in China for China, technology is manufactured locally, they completely avoid supply chain bottlenecks and import taxes.
Right, allowing them to price competitively while maintaining premium quality.
They are perfectly positioned to capture market share from slower, less adaptable local competitors who lack IR's global IP. They aren't waiting passively for the Chinese economy to recover to lift their boat. They have simply engineered a faster, more localized boat.
And speaking of engineering faster growth, any fundamental analysis of Ingersoll Rand is completely incomplete without a deep dive into their M&A flywheel. Mergers and acquisitions are not a sporadic side hustle activity for this executive team. M&A is a core structural feature of their operational DNA.
Their acquisition pipeline is notoriously aggressive. What does the specific data look like for their current deal flow?
Well, management disclosed that they currently have 10 separate transactions sitting at the letter of intent, or LOI, stage. But the truly critical metric is the sourcing methodology. Over 90% of these acquisition targets are internally sourced.
I really want to highlight the financial mechanics of why that 90% internal sourcing figure is so vital to an investor. Because usually, when a multi-billion-dollar corporation decides it wants to acquire a smaller competitor, it hires elite Wall Street investment banks to scout the market.
Right, and those guys aren't cheap.
No. Those banks charge massive advisory fees, and they often facilitate bidding wars that drive the final purchase price of the target company to an exorbitant premium. By the time the deal closes, the acquirer has overpaid so severely that it takes decades to generate a positive return on invested capital.
Exactly.
The fact that 90% of IR's pipeline is internally sourced means they completely bypass the Wall Street apparatus. Their own mechanical engineers, their own regional sales managers on the ground are identifying the most innovative private companies in their specific hyper-niche markets, and they're opening negotiations directly with the founders.
There are no middleman fees, no investment banker markups, and no artificial bidding wars. It is an incredibly capital-efficient method of buying growth.
It reflects an unparalleled depth of industry relationships. And we saw the mechanics of this strategy perfectly illustrated with their newly signed acquisition of an Italian manufacturing firm called FoxSRL. Let's delve into the specific engineering of this acquisition because the technological synergy is fascinating. FoxSRL is a leading European manufacturer of specialized equipment known as hydropneumatic accumulators.
Which, to the layman, a hydropneumatic accumulator sounds like a fictional component from a science fiction novel.
It really does. But functionally, in plain English, they engineer heavy-duty pulsation dampeners. So consider the basic plumbing in a residential house. Sometimes, when your washing machine rapidly stops drawing water, the sudden closing of the valve causes a loud, violent bang to echo through the pipes in your walls.
Oh yeah, plumbers refer to that as water hammer.
Exactly, water hammer. It is a severe pressure pulse caused by fluid rapidly changing velocity. Now, scale that concept up exponentially. Imagine that same violent pressure pulse occurring inside a massive industrial pipeline carrying highly volatile toxic chemicals at incredible speeds and pressures.
Yeah, a pressure pulse in that environment doesn't just make a noise. It shatters expensive dosing valves, ruptures steel pipes, causes hazardous chemical spills, and triggers millions of dollars in facility downtime.
And that catastrophic failure is exactly what FoxSRL's technology is designed to prevent. These heavy-duty dampeners act as mechanical shock absorbers for volatile industrial fluid systems. They absorb the violent pressure pulses, stabilizing the flow and protecting all the delicate, highly expensive downstream equipment from structural damage.
This is where the M&A synergy becomes so potent. Ingersoll Rand already manufactures and sells the massive high-margin pumps that physically push the fluid through the facility. By acquiring FoxSRL, they now own the proprietary shock absorbers that protect the entire fluid system.
It is a textbook, highly synergistic bolt-on acquisition.
Yep. Now, when an IR sales representative sells a $1 million pump installation, they can seamlessly cross-sell the dampener system. The pitch to the customer is simple. Include this proprietary dampener system, and we guarantee it will extend the operational lifespan of the primary pump by 5 years and drastically reduce your annual maintenance downtime.
It instantly increases the total return on investment for the factory manager while capturing more wallet share for Ingersoll Rand. But I have to ask the skeptical question here. Does bolting on these relatively small niche dampener companies really move the needle for a consolidated enterprise generating billions in annual revenue?
That's a fair question. When you isolate one transaction, it seems immaterial. But when you systematically replicate that highly strategic cross-selling bolt-on strategy across dozens of acquisitions globally, the compounded financial impact is staggering.
What's the target?
Management explicitly modeled that this internal M&A machine is expected to add between 400 and 500 basis points, which translates to 4% to 5% of pure annualized revenue growth in 2026 alone. They are not just hoping for organic market expansion. They are systematically engineering and purchasing their way into persistent high-margin growth.
Okay, so when we comprehensively review the first quarter, we see a picture of an incredibly resilient operational model. They are navigating regional geopolitical conflicts by relying on short-cycle aftermarket stabilization. They are circumventing the European energy crisis by selling highly measurable efficiency upgrades. They are out-innovating a sluggish Chinese macroeconomy through intense supply chain localization. And they're systematically bolting on 5% of annualized revenue growth through an elite, internally sourced M&A pipeline.
It's a veritable masterclass in operational navigation.
It really is. But as retail investors, the past is merely prologue. We have to analyze what management is promising for the remainder of the fiscal year.
And the forward-looking guidance portion of this transcript is where the most intense analytical debate occurs, because management is making a highly aggressive mathematical promise regarding their second half margin performance.
Let's lay out the official reaffirmation of their numbers first. Management formally reaffirmed their full year 2026 financial guidance. They're projecting total consolidated revenue growth of 2.5% to 4.5%, with approximately 1% of that representing pure organic growth at the midpoint of the range.
Okay.
They expect full-year adjusted EBITDA to land between $2.13 billion and $2.19 billion. They are projecting full-year EPS of $3.45 to $3.57. And crucially, they are maintaining an elite free cash flow conversion rate of 95%.
We really need to define that metric for a second. A 95% free cash flow conversion rate means that for every dollar of theoretical accounting profit the company claims on its income statement, 95 cents is actually converted into tangible, spendable cash deposited into their bank accounts.
It indicates extremely high earnings quality.
Yes, and minimal accounting manipulation. It is a hallmark of a fundamentally sound, heavy industrial business.
But here's where I'm going to challenge the narrative, because the calendar math requires a significant leap of faith from the investor class here. The ITS segment, which again is their largest and most vital segment, has suffered margin declines for 5 consecutive quarters.
Right.
Furthermore, management explicitly warned on the call that Q2 margins for ITIS are projected to decline by another 50 to 100 basis points year over year. So the margin degradation is unequivocally going to worsen in Q2 before it improves.
That's what they said.
Yet management is promising the market that the second half of the year will witness such violent, rapid margin expansion that it will drag the entire full-year average back to a flat or slightly positive outcome. They are projecting a heavily back-weighted recovery curve. This classic hockey stick. Q2 is guided down. How does the fundamental math suddenly miraculously fix itself in Q3 and Q4?
It is the single most critical vulnerability in their entire 2026 narrative. If an investor is going to trust this second half slingshot, they must rigorously audit the mathematical mechanics behind the slope of that recovery. But, to management's credit, they anticipated the market's skepticism. They didn't just ask analysts for blind faith. They provided a highly detailed 4-part mathematical bridge detailing exactly how they will execute that second half margin recovery.
Okay, let's audit the mechanics of that bridge. The first major driver they cited was tariff lapping.
Yes, tariff lapping is a fundamental concept in comparative financial analysis. Last year, during the second quarter, the company was abruptly hit with significant new global tariffs, which fundamentally altered their cost structure.
Right.
Those tariffs acted as a severe headwind, rapidly compressing their margins in the back half of 2025. However, by the time we reach the second half of 2026, Ingersoll Rand will be comparing its current quarterly performance against the back half of 2025.
A period where the financial damage of the tariffs was already fully baked into the baseline numbers. I want to use a running analogy to explain lapping a comp, because it perfectly illustrates the math. Imagine you are running a timed mile on a track. On your first lap, you are suddenly hit by a brutal 20-mile-per-hour headwind. Your lap time slows down drastically. Your performance looks terrible compared to a windless day.
Sure.
But if you run the exact same track the next day, and that exact same 20-mile-per-hour headwind is still blowing, your time won't look any worse than the day before. You haven't eliminated the wind, but you have lapped the impact. The headwind stops acting as a year-over-year drag on your growth percentage. The comparative math suddenly becomes neutral.
That is an excellent visualization of the accounting reality. The tariff costs do not vanish, but the year-over-year margin degradation caused by them mathematically ceases.
Okay, what's the second driver?
The second major driver of the recovery curve is delayed pricing realization. When those tariffs initially hit the supply chain last year, Ingersoll Rand obviously didn't just passively absorb the margin hit. They proactively raised prices on their global customer base to protect their profitability.
Makes sense.
However, in heavy B2B manufacturing, there is a massive time lag between issuing a new price list and actually recognizing the revenue. You have long cycle projects already locked into fixed price contracts. Management confirmed that the aggressive tariff combating pricing actions taken in late 2025 are finally working their way through the massive backlog.
Oh, I see.
So the actual cash from those higher margin sales will finally hit the income statement in full force during the second half of 2026, actively offsetting the inflationary pressures.
So they absorbed the punch last year, they renegotiated the massive multi-year contracts, and the elevated cash flows from those new contracts are precisely timed to hit the bank account in Q3 and Q4. Understood. What is the third mechanical driver of the margin expansion?
The third driver centers on aggressive procurement and direct material savings. Management provided a vital piece of context here. Direct materials constitute roughly 70% of Ingersoll Rand's total cost of goods sold.
70%.
Yeah. That represents the raw steel, the specialized aluminum, the microchips, and the heavy subassemblies. Over the past several quarters, their global procurement teams have been executing aggressive cost-saving initiatives, renegotiating supplier contracts, optimizing raw material sourcing, finding deep supply chain efficiencies. Okay. Now, in the industrial sector, the fourth quarter is historically their seasonally strongest quarter for absolute manufacturing volume. When you combine their highest manufacturing volume of the year with newly negotiated significantly lower raw material costs, you achieve massive economies of scale. The margin expansion benefit becomes mathematically outsized in the back half of the year.
It is the ultimate alignment of economies of scale hitting at the exact moment the deepest raw material discounts activate, and the final driver of this back-weighted recovery.
The final component is the delayed realization of global restructuring efforts. Late last year, management elected to take some heavy, painful accounting charges to fund a global restructuring initiative. They spent significant capital to reorganize redundant management teams, physically close overlapping manufacturing facilities acquired during recent M&A, and streamline their global logistics network.
Right, those upfront costs hurt.
They do. When you announce a plant closure, you take the financial hit immediately on the income statement. But physical restructuring takes months to execute safely and legally. The actual physical cost savings from operating a leaner, more consolidated manufacturing footprint will only begin yielding tangible margin benefits in the back half of 2026.
When you rigorously audit those four mechanical drivers, neutralizing the ugly year-over-year tariff comparisons, finally recognizing the delayed B2B pricing increases, timing massive procurement discounts with peak Q4 volume, and finally reaping the physical peril and facility savings of global restructuring, the aggressive second-half margin recovery isn't just corporate optimism. It is a meticulously engineered, highly plausible financial outcome.
It is entirely plausible, provided one critical caveat. The underlying macroeconomic environment must hold relatively stable. If the global economy completely craters into a deep recession, volume will drop so severely that no amount of procurement savings or tariff lapping will save the margins. They have engineered a very sturdy mathematical bridge. They simply need the macroeconomy to allow them to walk across it.
So we have thoroughly digested the headline numbers, we have analyzed the divergent segment performance, we have contextualized the geopolitical delays, and we have mathematically audited the aggressive second half guidance. Now we arrive at the core mandate of a Talk Tickers deep dive. What should you, the retail investor, actually do with this density of information? So what does this all mean?
It's time to synthesize the analysis into an actionable, opinionated stance on the equity.
I will take the lead on the verdict. Based on a comprehensive review of the data, I am adopting a distinctly bullish stance on this quarter and the long-term trajectory of the company. Yes, if you only scan the pessimistic financial headlines, you see a 3% organic order drop in their largest segment, and a superficial analysis might trigger panic. But when you apply the deep operational context we just discussed, that optical drag completely dissipates. You realize the $40 million Middle East delay is not lost market share. It is a temporary logistical freeze that is already actively reversing. You observe a company-wide book-to-bill ratio of 1.07, mathematically proving their future pipeline is expanding. You see explosive 15% cash flow growth in their highly defensible, high-margin medical segment. To me, this transcript reveals a fundamentally sound, incredibly durable enterprise that is temporarily masking its underlying pricing power behind a few highly explainable, transitory accounting blips.
I concur with that bullish assessment, particularly when you analyze the structural advantages that allow them to control their own operational destiny. Their internally sourced M&A pipeline is a highly reliable, capital-efficient growth engine that completely bypasses the unpredictable cycles of broad economic expansion. Furthermore, their demonstrated ability to execute highly localized strategies, such as the in China for China supply chain pivot, or selling measurable energy efficiency upgrades during the European power crisis, proves they can surgically outgrow hostile macro environments through targeted innovation. They are not passive victims of the global industrial cycle. They are actively engineering their way through it.
For you listening, if you are currently holding Ingersoll Rand stock or considering initiating a position based on this fundamental analysis, what are the specific metrics you must monitor? We have distilled this complex transcript down to 3 major actionable items you must track over the next 2 to 3 quarters to ensure the bullish thesis remains intact.
Actionable item number 1. You must ruthlessly track the ITS segment profit margins in Q3 and Q4. As we extensively audited, the entire foundational thesis of management's full-year guidance rests on the mathematical promise of margins expanding in the second half. They have promised the back-weighted recovery curve. We already know Q2 margins will be down. Right. But when the Q3 earnings report drops in late October, if that ITS margin shows further year-over-year decay instead of the promised stabilization and expansion, the narrative is fundamentally broken. It would indicate that either their pricing power isn't as robust as they modeled, or their complex restructuring savings failed to materialize on the factory floor. Q3 margins are the ultimate undeniable lie detector test for management's credibility.
That is the single most critical binary event for the stock this year. Actionable item number 2. Monitor the U.S. ISM manufacturing data. We noted that the ISM has successfully moved back above 50, indicating purchasing managers are actively expanding their inventory. Ingersoll Rand's highly profitable short cycle and aftermarket parts businesses are intimately correlated with this specific metric. If the ISM holds steady above 50 and begins to accelerate, IR's daily aftermarket revenue will thrive, providing an incredibly stable, high-margin floor for their quarterly earnings. However, if the ISM dips violently back down into the low 40s, it means the check engine light on the U.S. economy is flashing red, and you will need to rapidly reevaluate the short-term demand thesis.
And actionable item number 3, closely monitor the geopolitics of the life sciences API reshoring trend. We highlighted earlier that the precision medical segment is growing at double digits, and management explicitly called out that this explosive growth is heavily driven by biopharma and axopharmaceutical ingredient or API production physically returning to United States soil.
We need to contextualize the scale of this geopolitical shift. For the past 3 decades, the Western world aggressively offshored the manufacturing of base drug ingredients to Asia to save on labor costs. However, recent global supply chain shocks forced governments to realize that relying entirely on foreign, often adversarial nations for life-saving medical supplies is a catastrophic national security vulnerability.
Absolutely.
Consequently, both the private sector and the federal government are currently deploying billions of dollars in capital expenditure to build highly advanced, sterile biopharma factories domestically.
Precisely. This is not a fleeting quarterly economic trend. This is a massive, multi-decade, secular megatrend driven by national security mandates. Ingersoll Rand's life sciences equipment, the ultra-precise vacuum systems, the automated sterile liquid handlers are perfectly positioned to supply the foundational infrastructure for this biopharma manufacturing renaissance. As a retail investor, you don't necessarily have to take on the extreme risk of betting on which specific biotech startup will successfully navigate FDA trials to discover the next blockbuster drug. You can simply ride the massive wave of infrastructure capital expenditure by owning the heavy industrial company that supplies the mission-critical pumps required to run the new factories.
It is the classic sell shovels during a gold rush strategy applied to modern pharmaceutical manufacturing. It is a brilliant way to gain exposure to a high-growth sector while completely bypassing the binary trial risks. So we have rigorously audited the data, we have broken down the mechanics of the operating leverage, and we have provided a clear, actionable roadmap. But before we conclude this Talk Tickers deep dive, we want to leave you with a larger, paradigm-shifting concept to consider.
We want to pose a final, forward-looking thesis that wasn't explicitly debated by the Wall Street analysts on the call, but is profoundly implied by the underlying trajectory of the engineering data we just analyzed.
This is the specific type of fundamental insight that separates the casual observer from the sophisticated long-term investor. Lay the thesis out for us.
Currently, approximately 40% of Ingersoll Rand's total enterprise revenue is generated by their aftermarket operations. That encompasses the sale of replacement parts, the execution of long-term maintenance contracts, and the ongoing daily servicing of the massive hardware installations they sell globally. But management has drawn a very aggressive line in the sand regarding their future strategy. They are actively utilizing advanced IoT sensors and data analytics to drive toward a strategic target of generating $1 billion in pure recurring revenue by the end of 2027.
Let me stop you there to emphasize the magnitude of that statement. They are targeting $1 billion in subscription-like, highly predictable recurring revenue from a company historically known for bending heavy steel.
Right.
But if they accomplish that, doesn't selling predictive maintenance contracts inherently cannibalize their highly profitable hardware replacement sales? If a sensor prevents a machine from breaking, the customer doesn't need to buy a new machine.
It alters the revenue composition, but it drastically improves the quality and margin of the earnings. By embedding connected technologies and predictive maintenance software directly into the compressors, they can identify a microscopic vibration anomaly and dispatch a technician to replace a $500 bearing before the entire $50,000 compressor catastrophically fails.
Right.
They are transitioning the customer relationship from a transactional break-fix model to a permanent, predictable, high-margin monthly service agreement. They are effectively locking customers into a digital ecosystem. So here's the provocative thesis I want you to evaluate. If a heavy metal industrial hardware company successfully transitions a massive billion-dollar portion of its business to a digitally connected recurring revenue services model, does the broader market eventually have to stop valuing it as a cyclical, capital-intensive industrial manufacturer?
That is an incredibly compelling valuation argument. Historically, industrial manufacturers are assigned relatively low, conservative price-to-earnings multiples because their core revenue is inherently lumpy. It requires massive capital expenditure, and it is highly vulnerable to the boom and bust cycles of the global macroeconomy.
Exactly.
Conversely, pure SaaS companies, software as a service businesses, are awarded massive premium valuation multiples by Wall Street precisely because their digital revenue is recurring, highly predictable, and incredibly sticky.
Precisely the point. If Ingersoll Rand successfully executes that $1 billion recurring revenue target by 2027 and mathematically proves that their software integration and aftermarket loyalty have fundamentally decoupled their cash flows from the historical boom and bust cycle of heavy manufacturing, does the market eventually re-rate the underlying equity?
Oh, that's interesting.
Do institutional investors begin pricing the stock with the premium multiples traditionally reserved for a SaaS platform? Because if the market realizes that transition is occurring and applies a software-like multiple to their earnings, the current valuation of the stock is fundamentally structurally mispriced.
That is the ultimate long-term thesis every investor must monitor. Are we merely looking at a traditional factory floor bending steel, or are we witnessing the evolution of an industrial software platform wrapped in a heavy metal chassis? Understanding that distinction requires looking past the obvious. It requires looking past the loud, visible, robotic arms and the swinging conveyor belts. It demands that we rigorously audit the accounting mechanics, understand the physics of the underlying technology, track the geopolitical shifts driving the supply chains, and realize that the most valuable component of the entire global manufacturing operation is the invisible, highly predictable heartbeat driving it all. Thank you for joining us for this comprehensive Talk Tickers deep dive. Stay analytical, keep dissecting the data, and we will see you next time.